Kenya's Monetary Policy Committee deciding to retain the CBR as at 8.5%. The committee noted that inflation had remained within the medium-term target, while the exchange rate has been seen as stable. For more on this decision, John Kahara, investment manager at Stanlib Kenya. John, thanks for your time today. Of course, we know there have been so many cuts in the past year. So do you stand by their decision that it being the right one right now to wait and see approach when it comes to the overall outlook for monetary policy?
I think the decision to obviously hold the CBR rate at 8.5 was widely expected. Again, the reason for this is that if you look at even the cuts that we have had over the last 6 months, where in January we were sitting at about 9.5 to about now current 8.5, we still think that despite the fact that this is supposed to be a signal, and especially to the banking sector to sort of like lower their lending rates, that has not been transmitted, especially to the real economy. So what we have seen is that most of the banks are still holding their lending rates. It's probably 1 or 2 banks that have lowered by about 1 to 2% in the rate. So we think that more or less also if you look at also the risk side, if you look for example at the currency, there has been a slight depreciation in the local currency. If you look at the inflation over the last 3 months, there's been a slight uptick. Again, it's not that our view is that inflation is going to really skyrocket, but we think that slight upward movement, especially in terms of inflationary pressures, we think that that is more or less the reason why central bank thought at this point in time we need to anchor inflationary expectations to probably hold this rate at the current levels of about 8.5.
Mm-hmm. I mean, they also make note of the fact that average lending rates have continued their gradual downward trend. We know that certainly the CBK has been pushing for banks to cut rates even further. But do you think ultimately that the liquidity that the CBK is hoping will flow into the system is really flowing into the real economy right now?
I think if you look at especially the flow of credit, especially to the real sectors of the economy, I think that's slightly picking up. If you look at the key sectors, the traditional sectors such as real estate, construction, and so forth, it's likely that is likely to flow later into the year. And again, to also put things into context, remember we have also come from a heightened political environment with the elections that ended in March. So it's sort of like companies that had sort of like had a wait and see attitude. But I think now, obviously, with the fact that now the political space look much more clearer, we expect much more demand for credit to flow through. Now, in terms of the availability of credit and also in terms of the cost of credit, we think that obviously, as if you look at also the other treasury securities, which obviously banks would invest in, most of those rates, or rather the rates have significantly come down. And therefore, we think there's likely to be a substitution where most of the lending, most of the banks sort of like have a shift from the usual investment in treasury securities much more into lending, mainly to maintain their margins. Mm-hmm. Again, also the other thing is that obviously it's expected that the demand is also going to increase. With as we expected, the economic growth, as we saw in the first quarter, coming in at about 5.2%, we expect even much more growth within the economy. And by extension, I think the demand for credit will obviously continue to go up. And I think also as banks also try to, grow, especially their loan book, there's likely to be a slight sort of like downward movement in terms of the lending rates.
Mm-hmm. Let's see how that one pans out. Yeah. Certainly is contentious. We continue to talk about it. But, you mentioned the fact that you've got demand for credit continuing to increase overall there. Banks potentially opening up their lending book slightly more. There has been this recent uptick in inflation. The exchange rate is slightly weaker. Do you see this having an impact on decisions further down the line?
I think if you look at where we are, obviously we have been in a easing monetary policy. Central bank all the way from last year has been trying to sort of like increase the availability and also the cost of credit going forward. My view is that right now I think we have some small fresh risks that have come through, especially with what's happening within the MENA region, where it's where we export some of our tea and coffee. Again, also if you look at also the growth that is coming from the Eurozone, where we also export quite a bit of our horticulture. and other cash crops. Again, also that's not looking too good. So I think it's more of a question of also central bank trying to also buy some time to see how the whole economic space also pans out. My view is that it's likely that obviously if the economic growth also continues and credit also becomes much more available and inflation remains within the 5 to 7% sort of like levels, we're likely to have quite an extended period when, or rather 2 or 3 quarters where the central bank rate is not really raised but more or less maintained at the current levels. Well, to me, the risk on the upside, obviously, especially on the CBR, would come if currency was under pressure. Now, if you look at the currency, in as much as I say there's a slight depreciation, it's mainly on account of obviously what I talked about, but mainly if you look at the support side, with obviously with the issuance of the sovereign bond, which we are looking to issue, especially in the fourth quarter of this year, then obviously that's going to obviously support. If you also look at also the side of in terms of exports, it's also likely to assist us, especially in terms of firming up on our currency. So, in my view, I think there's no much big pressure, especially to raise it. I think to me, it's more of a stability. And again, also if you look at what has happened within the interest rate environment, you can see
John,
obviously the treasury securities.
Yeah, sorry, I'm so sorry. We're going to have to leave.